Hello and welcome everybody. Happy Friday, welcome to the end of another week, the start of a weekend, but first, another Sectors Made Simple webinar. I'm pleased to be here with you all today with a highly requested topic. We've covered bonds and other fixed income securities in the past, but some of you had questions about, well, how does inflation affect bonds? And beyond interest rates, what is duration? How does duration affect value? And instead of just holding a bond all the way through its maturity, how does duration affect your ability to sell that bond today? So today I wanted to talk more about bonds, but also expand this to talking about many different types of fixed income securities, both their benefits and their drawbacks, and how understanding what they are helps us to diversify our portfolio beyond stocks and get into other asset classes as well. Now, before we get started, I do want to remind you all of two things. One, we're going to have a very fun November planned because in expectation of, of Black Friday and Cyber Monday, I wanted to cover consumers a little bit. I wanted to talk with you all about the consumer staples and discretionary sectors, but more broadly, I want to cover tech. Tech is something that all of us use, but understanding more about it helps us in more ways than just one. So I want to cover many different technology literacy topics, how to protect your money online, how to avoid scams, how to educate your friends and family, and most importantly, your grandparents about scams. And lastly, as we get into Cyber Monday, I want to cover some very interesting topics on how you can get the most bang for your buck when it comes to buying new tech pieces in 2021. Also, November 1st, this upcoming Monday, is going to be, Sunday rather, is the last day to purchase a Sectors Made Simple subscription at the current price. Currently, the price is $600 per year, which gets you access to all of our members' webinars, both recorded and live. Gets you access to the Inversores en Sectores webinar series, as well as gives you access to the matrix, the backtesting engine, custom matrices, and everything that we are currently working on to make your life simpler. Now, on November 1st, Monday, the cost is going to be going up from $600 a year to $750 per year. To emphasize the value of buying right now, buying at the $600 price not only gets you that $600 price this year, but makes sure that your price will never increase. Whatever your price you start your subscription at, that is the price you will always have. So, get in today, lock in your $600 price, and join us next Tuesday for another webinar with the Girasoles as we continue talking about how spreadsheets and financial literacy in general helps us to invest simpler. But for today, let's get straight into the topic of fixed income securities. So if we head right on over to my desktop, we can get into the presentation. So today we're going to be talking about an asset class, and we're going to be talking about interest rates and returns, and we need to talk a little bit about the disclaimer, which is all of this is for educational purposes. It's not financial advice. I'm not telling you you're going to become a millionaire off of fixed income securities. So take it as educational advice. Past results can never guarantee future performance. Interest rates will always change, and we can't predict, based on what's happened today, what will happen tomorrow. Now, let's start general. What are fixed income securities? These securities are an asset class, just like stocks or commodities or currencies. It is something that we can invest in that isn't just shares in a company or money. Now, these securities vary from who issues them to how long they're for to the amount of risk that they expose you to. But there's one thing that stays the same for all of these securities. The name, fixed income. This refers to exactly how these securities provide you with returns, where fixed income securities pay out interest in fixed intervals at a fixed rate for a fixed period. So let's cover this a little bit more by first talking about what they are. Most types of fixed income securities start off by being issued by the institution. Companies, financial institutions, or good old Uncle Sam and other international governments. Many of these are initially sold at auctions. Usually treasuries are sold at auctions. Or Treasury Notes, Bonds, Bills are sold at auctions, while others are sold directly to buyers or through brokers. Now, these securities can also be resold after the initial issuing of that security. Now, these sales can be worth more than you initially paid or less than you initially paid based on a lot of different things going on. Now, there are different types of fixed income securities. The one you're probably all familiar with is bonds. Bonds are like an IOU, where you give a company your money today, and they say, I will pay you back in 20 years. But every year, I will give you a little bit of money as a thank you, and as a we haven't forgotten about you. Then we have Treasury Notes. These are called T-notes. They come in usually 2, 3, 5, and 10-year maturity with semi-annual interest payments. So twice a year, you get a good old check from Uncle Sam, or rather the Treasury Department of Uncle Sam, with your money. At the end of those 2, 3, 5, or 10 years, you then get the face value of it back. Then we have Treasury Bonds, or T-bonds. These have a little bit longer of maturity, up to 30 years, with a minimum value of $10,000. Then, on the shortest end of things, we have T-bills. These bills have less than a year maturity and are oftentimes sold at a discount. The last one, which is not issued by the government, but is issued instead by financial institutions, are certificate of deposits, or CDs. These are interest payments that a bank will make for letting you essentially use their money, letting them use your money. More on this later. Now, before we get into all of this, I want to talk about what you actually see when you're talking about a bond. Most bonds and, broader fixed income securities share a few common parts. The face value, which is how much the bond is for, the coupon rate, which is how much interest the bond pays and how often it pays it. Usually, you'll see these interest rates as annual amounts. Even if they pay semi-annually, they'll tell you the annual rate. Then we have the maturity date. When does the bond become, or when does the security go from being a caterpillar to a beautiful butterfly? AKA, when do we get our money back, all right? The maturity date is where they say, here's your $10,000 back. Thank you, come again. And then when we're talking about bonds, bonds will also have ratings, which is like the credit score for a bond, which is essentially how much risk is there. The worse the bond rating, the more the risk, but also because there's more risk, there will be the promise of more reward. So let's get started by talking. I'm going to save bonds for later because that's a pretty big topic. But let's start off with the Uncle Sam notes and bills. So we're going to start off here with Treasury Notes. These are fixed income securities that will be issued by the U.S. Treasury Department. Now, there will be municipal bonds which are issued by your city or your state, but that's a topic for another day, and in fact, we have a webinar where we talked about that in the past. For today, we're just going to focus on federal T-notes. These securities have maturities from 2 to 10 years and have a minimum face value of $1,000 with increments of $1,000. So you can pay $1,000, $2,000, $3,000, $4,000, $5,000, up to the millions. So you can buy these directly from the US government, aka the US Treasury, at treasurydirect.gov. Going here, you need to create an account, you put some money in, and then you can start buying these T-notes. But if that's a little bit more than you want to get into, you can also buy these through many, and by many I mean most, financial institutions and investment brokers. So Schwab, Fidelity, TD Ameritrade, whoever you use will help you to facilitate these purchases. But even if that is too much for you, or if you just want to keep things simple, there are also ETFs that trade Treasury notes, such as SHI, GOVT, TLT, and more. If you're interested for the entire list, I will refer you here to etfdb.com, where we have a list of all of the different all the different ETFs that invest in Treasury bonds. And now keep in mind, these will vary. That list there is going to include notes, bills, and bonds. Now, important ding, 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 important little thing. Treasury ETFs can be held in IRA accounts. And the reason I say this is because Treasury securities cannot. Treasury notes, securities, Treasury notes, bills, and all of the such, we're just going to call them securities. Treasury securities cannot be held in an IRA account. However, they do have their own benefits. Federal Treasury notes and securities you do not need to pay state or local taxes on them. You only pay federal taxes. So it does have some tax advantages. Again, if you're looking for something to throw in your IRA account, then ETFs might be the best. Well, ETFs are your only option if you're looking here at Treasury securities. So that's Treasury notes. Now, if we get into Treasury bonds, T-bonds are very similar to Treasury notes in that they are issued by the US government. These T-bonds have maturities of 10 up to 30 years with twice a year interest payments. Now, these T-bonds are primarily sold through auctions, through Treasury Direct. There are two types of buying T-bonds: competitive and non-competitive bids. Because again, these are auctions here. Now, what in the world are these? Is competitive like you've got a rank and your rank goes up when you win and goes down when you lose? Non-competitive is just for fun? Not exactly. Competitive bids, or in competitive bids, the buyer says, I want this interest rate for this period. Take it or leave it. And then what the Treasury will do is they'll say, all right, this is the best offer. This is the worst offer. I'm going to go best, slightly worse, slightly worse, slightly worse. And they're going to fill their orders from the best offer to the worst offer. After they've done all of this, they then go to the non-competitive bids. The non-competitive bids, the buyer is guaranteed the bond. So competitive, you're not promised to get a bond. It's just saying, here's the offer, take it or leave it. And they might say, well, leave it. For non-competitive, you're guaranteed to get the bond. But you don't get to set the interest rate. The interest rate is set by the Treasury Department. And the interest rate that non-competitive bids get is the rate set by the competitive bids. So the competitive bids is this shark world of we're eating the smaller fish and then the bigger fish grow bigger. Non-competitive bids is the people that just get to say, all right, we'll take whatever shows up on our plate. People like you and me, we fall into the non-competitive bid section. We, and I'm going to say the royal we here, there's some people that can probably calculate bond values pretty well. But the average investor is not going to be able to. We don't have the tools, resources, or the capital really to get competitive with it. Competitive bids, that's going to be your bigger institutions, people that are throwing millions or billions of dollars at different bond payments. To give you an idea, in 2020, the US Treasury processed $12 trillion in bonds. I don't know about you, I don't have $12 trillion. So someone has to be buying all of these bonds, and I'm sure it's not me or you or Juan de los Palotes. It's going to be the institutions, the big hippos. So we let the hippos get in the water and figure out where the water level is, and then we get to decide if we want to dip our feet in and go for a swim. That's competitive. The competitive is the hippos. They get in and figure out, based on how much they sink, where the water level rises to. After the water level rises, we then get to say, all right, the water is 20 feet deep. I'll get in. The water's 200 feet deep. I'm good. That is called the primary market. It is the first time those bonds have hit the market. After that, we can go thrift shopping if we want in the secondary markets. Secondary markets let investors, both retail and institutional, buy and trade treasury bonds. Now, these are already issued, so they won't be your very fixed increments, but what they will be is they will be stable. We expect treasury bonds and most treasury securities to be fairly stable because it's tied to the strength of the US government, the US economy. The only way we default on these is if the entire US economy defaults, which we'd have bigger issues than just bonds. Now, let's talk here a little bit about treasury bills, because I didn't really talk too much about it before. These are the shortest term bond or really deposit that a US Treasury will issue. These debt obligations mature in less than a year, with some being as short as 4 weeks, with the longest going up to 52 weeks. The longer the duration, the higher the interest rate. But we're talking tiny, 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 tiny interest rates here. So how do we make our money? If we're talking hundredths of a % of interest, we've got to be making our money somewhere. And the place that we make our money is not in the interest payments, but in the face value itself. Imagine if I took, that's a receipt, I should have a $1 bill somewhere in here. What if we took a single dollar bill? And instead of saying, hey, Jonathan, I'll give you $1 for your dollar, I said, hey, I will pay you $1 in a year if you can give me 50 cents today. Pretty good deal, right? So what they'll do is they'll say the face value is $1. And now I have half a dollar. Pretend this is a half dollar. I'm not actually going to rip $1. This is now half a dollar. This is what I want you to give me today. Half a dollar, and then I will give you a full dollar in 1 year. Plus, we're literally talking like a quarter of a penny is how much interest you'd make on a single dollar. That's how Treasury bills work. The money you make is not from the interest. The money you make is completely from the fact that you pay less than the face value, but you get the face value at the end of that period. Then the last one before we get into the big bond conversation are certificate of deposits. These certificate of deposits are, go figure, fixed income securities that are issued by banks, credit unions, and other financial institutions. These can be thought of like interest in your savings account. But instead of being something that you can put money in and take money out and put more money in and put less money in and all of that, however often you want, these have a little bit more stringent rules. They're a little bit more strict. The institution will say, put in a certain amount of money, leave it there for a certain period of time, and after a certain period of time, really annually, we'll give you interest for letting us use your money. Banks do not sit on billions of dollars at a time. They don't sit on a ton of cash. What they will do is they will take money from people's savings accounts and all of that. You give them the right to use your money to invest, to loan, to invest in equities, to invest in securities. And in exchange, they give you a teeny tiny bit of that. CDs are a way for them to do that, where instead of needing to worry if you're going to go cash out your savings because the market just tanked, they know that your money is going to be in there for 2 years and it's going to be $5,000, and they're going to give you like 0.9%. If you're interested for how much they will give you, there's a website called bankrate.com that will give you lots of information about banking. So it will give you CD rates per bank with how much they require, how long, and then there's some other things like, if you want to break the contract early, what you pay in penalties and all that kind of stuff. So if you're interested in that and you want to start shopping around, bankrate.com is a good place to look at all of the different options there might be, because different institutions will offer different rates for keeping different amounts of funds for different amounts of time. The last thing about this, CDs, remember, Treasury stuff is backed by the US Treasury. Certificate of deposits are insured and backed by the FDIC up to a value of $250,000. Can banks fail? Yes. Will banks fail? Probably not. But in case they did, your money is backed up to $250,000. Now, let's get into the big topic for today's presentation: bonds. A lot of the options that we've just talked about are backed by the US economy, by the US Treasury, or by the FDIC. They are nearly risk-free. Nothing is risk-free, all right? There's risk in everything. There's risk in having your money in stocks, in bonds, in T-bills, and under your bed. There's no safe place that is 0% risk for your money. But they're very low risk. Bonds give us a lot more option here, where we get to choose how much risk we're willing to take for how much reward we want. So there are different types of bonds, but today we're just going to focus here on corporate bonds, companies issuing IOUs, basically. When a company wants to raise money for a new project, what they might do is they might issue bonds. This allows them to raise a ton of money because you give them the face value right away. That's a lot of money for the company. They will then take that money and they'll use it and spend it, and that money is now thrown into the company. So then what they will do is hopefully that company will make profit. And when they're making their profit, they will pay you interest on that bond amount. And then after that bond's maturity, they will pay you out the entire face value of that bond. So if the bond is $1,000, you pay Juan de los Palotes Incorporated $1,000, and they say, all right, every year we will give you 3% interest. So every single year, you get a check for 3% of $1,000. Then, at the end of the term, whatever the duration of that bond is, or once we reach maturity, it's grown up, it's ready to leave the nest and go off to college, they'll pay you back that $1,000. Now, that's good. That's great when the company will actually pay you back, but not all companies do. Some companies cannot pay back their bonds. So how do we know who can and who can't? And how do we figure out what the correct risk versus reward is? There's crazy calculations out there and supercomputers that are running these wild calculations to find the correct value of bonds and buy the things that are undervalued and sell the things that are overvalued and all of that. For people like me and Juan de los Palotes, that's a lot. We don't want that. So instead, what we can do is we can look at bond ratings. We let the people with those supercomputers and the actual know-how to figure out what a bond is worth, we let them do their job, and we just piggyback off of their work in a program called bond ratings. Bond ratings can be thought of like your credit score. Different credit agencies will say, Jonathan has this much of a chance of paying back his loans. And they'll give you a score from 0 to 150. If you have 0, there's some real problems. But usually it'll go down to like 400, 450 is the lowest you'll ever see. The highest is around 850. That's personal credit scores. Bond ratings are the credit score for a company. They are not only given to the company, but to the bonds themselves, and are rated on the likelihood to pay back the interest rate and the face value of that bond upon maturity. In the United States, there are 3 main agencies that are responsible for issuing bond ratings: Moody's, Standard & Poor's, and Fitch. Each of these agencies will have a different scale. They will rate things from AAA. All of them start with AAA is the best of the best of the best. The worst of the worst of the worst is C for Moody's and D for Standard & Poor's and for Fitch. Now, while each of these rating agencies have a slightly different scale, all bonds fall into 2 main categories. Investment grade. Investment grade is the chef's kiss, great. These are very likely to give you your return kinds of investments, or types of bonds, really. Guess that is a type of investment. These ratings for investment grade range from AAA to Baa3 for Moody's and BBB- for Fitch and Standard & Poor's. This is investment grade. This is the things that investors will look at and say, I'm not really worried about not getting my money back. I'm pretty confident I'll get it back. Below that, we get into the world of junk bonds, or sometimes called trash bonds. These bonds will have a rating from Ba1 for Moody's and BB+ for Fitch and for Standard & Poor's. just like when you apply for a loan or when you get a new credit card. Higher risk, or rather worse credit, worse bond ratings, it's not going to prevent you from issuing bonds. It's not like someone is going to say, nope, you can't issue bonds. Instead, all it's going to mean is that your interest rate is going to be a little bit higher. The bond yield rate is going to be higher. That's exactly how bonds work. The worse the rating of a company, the higher the interest rate that they'll need to offer in order for people to want to take those bonds. Now, bond ratings are a valuable tool, but they still have some risks. But the risks aren't so much in the bond ratings as it is in the fact of bonds being fixed incomes. Fixed income securities sounds like a pretty good deal when you think about it, just in daydreams. Low risk for guaranteed reward, right? Yes, but that's not everything, because that's today. Today, a company might be doing really well. Tomorrow, something might hit the fan and the company's no longer doing that well. If the financial status of a company changes, the company might get downgraded. And when that happens, your interest rate stays the same. So just because you got in at a 1.5% interest rate, let's say, the bond rating tanks, and now the only way that they can sell bonds is at a 4% interest rate. You don't get bumped up from 1.5% to 4%. You're stuck at 1.5%. So if the company gets downgraded and the coupon rate goes up, you don't get to benefit from that. But the value of that bond goes way down, because this opens you up to more risk with no change in reward, and will affect the price at which you can sell that bond in the secondary market. Remember, there's two ways to get the big chunk of your money out of a bond. You can either hold that bond until it reaches maturity, watch it spread its wings, and hopefully lay you a couple of golden eggs in the process. Or you sell it. You give it to someone else so that they can hold it through maturity or until they want to sell it. These are assets. These are securities. These have value in the market. So you can go and you can sell your bond to Juan de los Palotes for some amount of money today. You stop getting your interest payments, but you didn't need to wait 30 years to get your money back. You got it like that. If the bond rating for a company tanks, the coupon rate that company is now issuing bonds at skyrockets. The value of your bond is going to crash because that bond is no longer as valuable. There's a lot more risk with no more reward. So when there's more risk and less reward, people are willing to pay less for that bond. But that's not just a risk for bonds. That's a risk really for all fixed rate securities, because there's one enemy of them all: inflation. Inflation is the enemy of fixed rates, because fixed rate bond payments are calculated using simple interest. You get 2%, 3%. So if you have a $1,000 bond and it pays 3% annually, you're getting $30 a year. They don't reinvest that $30. It doesn't now become $1,030. It's always going to be, you're getting $30 a year. For 2 or 3 years, that's not a big deal. For 20 or 30 years, we've talked many times on this channel before about a gallon of gas used to be 5 cents, a hamburger was 10 cents, a gumball was 1 cent. Now, a gallon of gas is close to, or if not above, $5 a gallon. A burger is $8, $9. The value of money changes. And usually, the value of a dollar goes down. Inflation is expected. And in fact, inflation to a small extent is a good thing. It encourages people to spend their money, because when your money is going to be worth less tomorrow than it is today, you're more likely to spend it today. That's why when the market is not doing well and the economy is suffering, the Fed, the Federal Reserve, will try and encourage people to spend by increasing the inflation. They'll throw a bunch of money into the economy and say, go, spend it, because guess what? Tomorrow it's going to be worth less. And it works really well. That's why they do it. They do it because it works. So what will end up happening is, if inflation goes up, your fixed rate doesn't change, and the amount that you are making isn't what $1,000 is worth today, it's what $1,000 was worth back when you bought that bond. So again, face value times the interest rate is what you end up getting paid. This value does not change over time, nor does the interest amount change over time. But the value of that money might and will. So how does this actually affect our bonds? Well, there's something called duration. Duration here is kind of like beta for stocks. But instead of us talking about how much the value of a company changes based on the S&P, here we're going to talk about how the value of a bond changes based on inflation rates. So it tells us how sensitive the bond is to changes in interest rates, both inflation but also the federal interest rate. This duration is going to take into account the present value of the bond, the coupon rate, years to maturity, face value. It's a crazy formula that is not worth us getting into. So let's ignore the formula and just talk about why it matters, all right? If you're interested in the formula, there's the simple form of the formula, and then there's the advanced form that's going to include adjustments for inflation and all sorts of crazy stuff. Long story short, bonds with longer duration will gain or lose more value than a bond with a shorter duration. That's all it comes down to. It's basically volatility. If inflation changes by 1%, something with a longer duration is going to be much more affected. The value of it is much more affected than something with short duration. That's all there is to it. Now, again, all of this comes back to the risk in all fixed rate securities, because the effects on inflation of bond prices and the bond market, and don't forget, the mutual funds and ETFs that invest and trade bonds, will lose value when inflation rises, but gain value when inflation lowers. Today is October 29th of 2021, and today, the average 30-year Treasury bond is trading at a 1.94% annual interest. There is something called the bond yield curve that if you're ever interested in bonds and you want to see how bond rates change based on the actual maturity length, go check out the bond yield curve. It's a big arc that shows you that it starts off where short durations will have a much higher change in interest rate. As the duration gets longer and longer, it flattens out and starts really shortening after a certain point. So the percent change between 0 and 5 years is bigger than 5 to 10 years, which is bigger than 10 to 20 years, which is bigger than 20 to 30 years. So let me see if I can quickly find... Wow, that's a very basic idea of it, but this will get the point across. Here is going to be the Treasury yield curve. The borrowing period, remember, as in the very, very short periods, we're going to see significant change. As the period gets longer and longer, it starts to flatten out more and more. So again, let's go back here and do an example of today, October 29th, 2021. The average Treasury bond is trading at 1.94% annual interest. And if we were to apply this using the most complete year that we have for inflation, we're going to look here at the 2020 the 2020 inflation rate, which was 1.78%. We would get something like this. On the far left, you see years. Year 1, year 10, year 20, year 30. The first column here, after the year, is our total interest. This is how much we have made in interest payments. That's what we've gotten paid day by day. By the end of year 30, we will have gotten paid $5,820. But every single year, the amount that bond is worth, if we started here with a $10,000 bond, that bond is going to lose value every single year due to inflation. But while your interest is calculated using simple interest, the rate at which the face value changes is compound. So by the end of year 30, if we just stuck with the 2020 the 2020 inflation rate of 1.78%, your $10,000 face value ends up being worth $5,800. Now, this is the best case scenario because this is saying that your interest hasn't really depreciated, but it's depreciated as well. But we're going to ignore that because you get that money over time. So we're just going to say you spent that money as you got it. The total value by the end of it all, adjusted for inflation, would be about $11,600. So you made a profit of $1,654.52 over 30 years. When you invested $10,000 to start with, and all you got after 30 years was $5,800 back, and then $5,800 worth, it's kind of tough sell. But that's how it is for Treasury Notes, Treasury Bonds. We are talking extremely low risk here. So when there's extremely low risk, there's also extremely low reward. Now, that was the 2020 interest rate using 1 year fixed inflation rate for 30 years. We're not going to be able to expect that the inflation rate is going to stay the same. Because remember, this rate, 1.94%, thinks about what the interest, why do I keep saying interest? The inflation rate is. The inflation rate will change and is expected to change and changes all the time. 1.94% is the calculated rate as a result of all of those competitive bids. They've done the calculations, so we didn't have to. Now, let's, instead of taking the inflation rate from 1 year, let's take the inflation rate from the past 107 years, from 1913 up to 2020. That inflation rate is a little bit different than 1.78%. It ends up being 3.1%. Let's do the exact same calculation we did before, assuming that you took your interest payments and you immediately went to invest those interest payments, you immediately went to spend them so that that's not subject to inflation. The only thing that matters about inflation is what that $10,000 is worth when you finally get it back. This would change our numbers to be something like this. That $10,000 at the end of year 30 is going to be worth less than $3,900. Yeah, you still made your $5,800 that you got to spend every year, but with 3.1% inflation, your $10,000 initial investment has depreciated to less than $3,900, and your total value is less than $10,000. You lost money. You lost net value over this period of time because of the change in inflation rate. So, is your money backed when you invest in treasuries, in Treasury Notes and Treasury Securities? Unless the US government and the US economy fails, yeah, it's backed. But what's not backed is inflation. Inflation will change, and we can't guarantee that this year's inflation, which is what your interest rate is based on, will be like that forever. Inflation rates will change, and when they do, if they change for the worse, if the inflation rate goes up, how much that face value is really worth when you get it back tanks. Inflation goes up, the value of that face value goes down, and when face value goes down, duration goes up. When duration goes up, then the value of that bond goes down. So inflation goes up, bond value goes down. That's the nature of fixed rate. Yes, you get to lock in that rate. Yes, you get regular payments. And yes, eventually you'll get your good old $1 bill back. That $1 bill in the future is not going to be worth anything. Fun fact for you all. Back in the day, a penny used to buy you a gallon of gas. It would buy you a gumball. A gallon of gas was like 5 cents. Some countries nowadays, because of inflation, they've stopped issuing pennies. They don't do pennies anymore. In fact, the US government loses money on every penny it prints because it costs them more money to create a penny than that penny is worth. Why do we still have pennies? Well, some governments don't. Some economies don't. In fact, Canada does not have a penny anymore. Instead, they round all transactions. So if your transaction comes out to $5.01, it'll get rounded to $5. Ta-da! Penny gone. Problem solved. That's what we're dealing with when we talk about inflation. Something that used to buy you a gumball is now a rounding error for every single transaction made. And not just that, the value of that penny is now less than what it costs to make it. That is why inflation is crazy. It changes everything, except what it really costs to see things happen. Fixed rate is subject to that. The penny that existed when you bought that bond is no longer even a thing when you go and sell it. Kind of crazy to think about. This dollar is not going to be worth $1 next year. It's going to be worth like 98 cents. Ta-da! So after saying all of this and talking about the woes of fixed rate, are bonds and other fixed income securities bad investments? No, not at all. Romulo, I'm actually going to stop and answer this question. This is an amazing, well, not question, comment. I think we need to understand how inflation affects our daily life in the economy. Amazing, amazing, amazing statement. Let's talk about that for a second. Does inflation affect the fact that I have $1 here and that I'm worried about what that dollar will be worth tomorrow? Kind of. If the value of $1 is going to be worth less tomorrow, I'm more likely to spend that dollar today. But the price of Chipotle is not going to change every day. So I'm not going to see my day-to-day prices changing. It might change a little bit, but other market effects are going to have a much larger impact on our day-to-day. But inflation is mostly going to affect fixed rate securities, but also banks. So when things change with the banks and what the value of money is to a bank, it's going to affect how the banks interact with us. That's where we're going to feel the most change, is from the institutional side of things. For consumers, you're only going to notice it when Chipotle says, all right, the cost of our materials has gone up. A burrito is now $9. Guacamole is now $2.45 instead of $2. Makes me so sad. But that's how it is. Are you going to notice it when you go down to Starbucks and buy your cup of coffee, or you go and buy your burrito? No. You're not going to notice daily inflation. But you will notice it when you look at interest rates. And most importantly, you'll notice it when there are large changes in how the Federal Reserve is working with our economy. Right now, the Federal Reserve is starting, they have not started yet, but they are starting to want to scale back how much they are buying bonds, because they've been throwing a ton of money into the US economy because of COVID. They've wanted to have people spend more. So they've drove inflation way up. And yeah, it does encourage us to go and spend more. At a certain point, though, they're going to stop. And instead of throwing money in, they're going to start taking money out. They're going to issue more bonds, or they're going to release some of these bonds back into the market. And in exchange, they're going to take money and just sit on it. They're not going to spend it, they're just going to hold it. We're going to feel that. Again, we're not going to feel it in our day-to-day. Your price of coffee or your price of a burrito is not going to change. But on a large institutional scale, inflation does matter, and you will feel the effects of inflation regardless if you're a bank or a consumer. At some point you will feel it, but you're not going to feel it today. It's kind of how it comes. The other way I can put it is, if you're indoors and the temperature just changes 1 degree at a time, you're not going to notice. You're only going to notice when it has gone up 10 degrees and you're like, all right, why am I still wearing a jacket? But it takes you saying, wait, why am I wearing a jacket, to realize that it's now 80 degrees inside and not 50 or 60. So hopefully that helps to answer the question in a very long-winded way. Again, the economy is never something that is an easy answer, or has an easy answer, let's say. So let's finish up this presentation, because there's only a few slides left here. So are bonds bad investments? No, they are not bad investments at all. I've just covered the example of Treasury bonds. These essentially zero risk bonds. But any corporate bond is going to offer better rates because there's a little bit more risk. So I'm going to use two examples here of very large companies that arguably people say are too big to fail. Apple. Apple is currently offering 2023 maturity bonds with a coupon rate of 2.4% and a bond rating of AA+. Extremely good investment grade bonds, very low chances of defaulting, 2.4% interest compared to what we saw before for the federal. That's an option. We always have that option. Let's now look at another trillion-dollar company, Tesla. Tesla, by the way, is now a trillion-dollar company. Thanks, Hertz. Tesla is offering 2025 maturity bonds with a coupon rate of 5.3%. But you think of Tesla as this big, strong company. They're considered to issue junk bonds. Double B is a junk bond rating. Because of that, they have a higher coupon rate. The more risk there is, hopefully the more reward. Now, it's kind of crazy to think about because we think of Tesla and Apple as being too big to fail companies, trillion-dollar companies. So why is it issuing junk bonds? Why are they considered to be junk bonds? Well, let's use an example of a company that some said was too big to fail, yet is currently failing. A perfect example here is the Chinese real estate company Evergrand. Evergrand was the 122nd largest company in the world. And despite this, the company has been issuing junk bonds for years. This year, the company began to miss bond payments. And we're not just talking a few, we're talking millions of dollars of bond payments. And they've ran into some serious risks of defaulting to the point where their September payments that they needed to make for interest payments, they just paid back. They were 2 to 3 days short of defaulting completely on these bond payments. So they survived September, but they still have more maturity payments to make and more bond payments to make in 2022. So they've staved off disaster for now, but we still don't know if this company will survive, given that right now they're barely holding on. 122nd largest company in the world, some said was too big to fail, is currently at risk of defaulting on their bonds and their bond payments. Is there a minimum to buy bonds? Yes, there is. Each bond will have a different minimum amount. So when you look up the bond, it will say what the minimum investment is, as well as they will have what's called the increment amount. So they might say the minimum is $4,000 and the increment is $1,000. So the minimum is $4,000 and then you can buy $4,000, $5,000, $6,000, $7,000, $8,000, $9,000, all the way up. So now let's just talk about the takeaways, because we've covered a lot of information today. Fixed income securities are valuable tools, and I wouldn't have covered it if the entire tagline of it was, well, inflation beats it, there's no point. These are valuable tools for investors. They offer many variable risk options, where in some of these cases, they're close to zero risk, and even offer some tax benefits, where federal, you don't pay state or local tax. Municipal bonds, you don't pay federal tax. So there are tax advantages to many of these investments. And it's a lot easier to get started with some of these choices than you might think, because the investment broker that you currently use probably offers bonds and Treasury Notes and bills or at least will help you to facilitate those investments. Investors can hold these securities to maturity, but you can also sell them early on the secondary market for whatever the value of that bond is at that time. You don't need to wait 30 years for you to see that face value. You might get that face value more or less at any point. The last thing here is that fixed rate securities do have some drawbacks. They're not perfect, inflation can change, and most of fixed income securities are vulnerable to changes in inflation. But that shouldn't deter you from looking at them at all. It's a consideration, because when there's low risk in getting your money back, there might be risk somewhere else. There's no such thing as free money. There's always risk in investing anything. But keep in mind, if you got the cash sitting around in a dollar bill, that dollar bill is still subject to inflation. Everything in the world is subject to inflation. So don't look at fixed income bonds as saying, well, why would I invest in it? Why would I invest in it when I'm going to lose money? Not investing at all, it's losing money anyway. Inflation is in everything in the economy. So when it's in everything in the economy, bonds give you something. It's better than having $1 in your wallet, I'll tell you that much. So that's all I have for you all today. That's all. A lot of information today. But I really wanted to be thorough as we talked about this asset class, because it is one that is very interesting and, again, has mutual funds and ETFs that give you much easier exposure than going out and figuring out how to make a Treasury Direct account and dealing with that yourself. So if you're interested, there will be some links in the resources section, as well as I've posted them in the chat. And as always, you can feel free to email us at support@sectorsmadesimple.com if you have any questions. But until next Tuesday with our members webinar, thank you all so much for joining us here. I will see you all in November as we get to begin our month of tech. So until then, thank you all so much. Happy Halloween, and we'll see you all very, very soon.